When you start in trading, you see a bit of everything. You see people making huge and insane returns, and you see also people losing money or maybe losing everything. And it's very hard when you start with trading to know what returns actually should you expect. That's why I wanted to make that video to give you my opinion on which type of return should you expect. Regardless if it's like trading or if it's more investing in its broader term, I wanted to give you my opinion because I think that there's a lot of misconceptions out there, especially when you start out with options. And if at least you can have the right expectations or maybe more realistic expectations, you're probably going to do better because at least you won't be tempted to do some very aggressive moves because you know that's the long term that actually matters over the short term. But before diving into this video, if you like this type of videos where I share my opinion on, for example, on which type of return should you expect, then don't hesitate to subscribe and liking this video. That's the best way to let me know after that in my analytics which type of video would you like to see more of. And I know that returns and all of this and what are the expectations is obviously a very, very important thing because let's be honest, when you start out trading or investing in general, you obviously want to make positive returns. You're not in that game to lose money. You obviously want to, make your money grow and essentially have a bigger account compared to what you started with. However, with everything that is out there, people telling you that they make, huge returns, it's very, very hard to have actual realistic expectations of what is actually doable and what is actually impossible to achieve on the long term. So what's a good performance? Well, to know what's a good performance in its relative terms, I think it's important to understand what are the top investors actually achieving in terms of annual returns so we can have some kind of benchmark. So the first one that I'd like to cover, and probably the most famous one that absolutely everyone refers to, is Warren Buffett. Warren Buffett has been achieving an annual return over, I think, the last 30 years. He was around 20% a year. Meaning that if you have, let's say, $1,000, then a 20% return would make you $200 after your first year. So you would end up with $1,200 after your first year. And 20% a year might not seem like a lot when we, for example, look at a number like $1,000 and then you earn 20% and then it's $1,200. However, what's really, really important here, and that's really the essence of all of those people that have achieved amazing track records over the long term, is that you have the compound interest that comes into play. And for those who might not be aware of what is the compound interest, basically if you make $200 on your first year on a $1,000 account, then you made a 20% return on those $1,000. However, if you made 20% on your first year and you end up with a $1,200 account, if you once again make 20% on that account, you're not going to make $200. You're going to make $240 because 20% of $1,200 is $240. So you see that you already make more than what you made in your first year. In your first year with a $1,000 account, you made $200. In your second year with your $1,200, if you keep making 20% a year, then you make $240. So you see that you made $40 more compared to the first year. That's compound interest, meaning that with the same return, if you keep doing this, your money is going to get compounded. And that's really the compound interest. With the same return, you're going to make more and more because now your base money, your account is going to get bigger, and 20% of, let's say, $1,200 is bigger than 20% on $1,000. And that's what compound interest is. And there's no hazard why, Einstein called the compound interest the eighth wonder of the world, because, on the long term, it can really, really be powerful. And I'm sure that you heard about the net worth of Warren Buffett, and I'm sure that you've seen this type of graph. Like you should see one right now on the screen where it's Warren Buffett net worth over the very long term. So of course, it's not as simple as just putting a graph and the compound interest, but you get my point. My point is that compound interest on the very long term can really be powerful. So that's for Warren Buffett. Obviously, everyone talks about him and he has a very, very big net worth. But what about other investors? Is everyone achieving like this type of returns? Another famous investor called Ray Dalio, who is managing Bridgewater Associates, he's averaging around 12% a year. So you see that it's actually less than Warren Buffett. And if we look at the typical hedge fund, so hedge fund would be an organization that is supposedly hedging against market crashes, and they're supposedly managing their clients' money so as to hopefully generate positive returns. At least that's the goal. Well, on average, and that's really an average, but just to make you understand the big picture, they're going to average average around 10% a year. So you see that it's not at all like a 50, 60, 70% a year. Like it's already good if you make 10%. So you see that those returns, just looking at those people, like for example Warren Buffett or Ray Dalio, or if you look at any other type of very famous investor, you're not going to see returns of like 100% year after year after year. You see that those returns are pretty much like way lower than this. It's this like 20%, but the key word here is really long term. If you can manage to achieve, let's say 20% a year over like, let's say 30 years, then you're genuinely among the top investors of all time. That's really impressive if you manage to do this. And I built a spreadsheet where basically it's going to show you what would be your returns after, let's say 30 years. And as you can see at the top, the starting capital, let's say that if you were just using $1,000 at the very beginning, and if we base ourselves with a return on investment of 20% a year, which was, for example, Warren Buffett's average annual return over the last 30 years, then you would end up at the end of those 30 years with $237,000, just starting from $1,000 30 years before. So yes, it's true, it's 30 years. It's actually a very, very long time. However, you can see really the power of compound interest because you end up with a lot more than what you started with. And there's not even like a question. And it's actually just in the last years where you make the most money. And if we add another 10 years, so now instead of ending at 30 years, we end at the 40th year, then you see that you could almost end up with $1.5 million just starting with $1,000 40 years before. And of course, as I said, you know, it's 40 years, it's a very long time. However, you still end up with $1.5 million just starting with $1,000. And not even taking into account the fact that if you have dividends or if you just reinvest them, it's purely if you manage to average an annual return of 20% a year. If you start out with $1,000, 40 years after, you end up with $1.5 million. And that's the beauty of compound interest and just keeping doing the same thing over and over on the very long term. And that's why guys, for example, like Warren Buffett or most of the very famous investors got so rich, because they really understood that and they really played on that effect. And if you look at the S&P 500, so that's really considered as the benchmark, you know, you're going to compare your performances against the S&P 500. Because if you underperform the S&P 500, then you might as well buy an index fund on, for example, with the S&P 500, so you just, you know, make better returns by just following the market. And that's why a lot of people usually compare themselves to the S&P 500 so as to see if they're actually underperforming the S&P or if they are overperforming the S&P 500. And over the last 30 years, the S&P 500 has averaged an annual return of around 7%. So you see that, you know, it's kind of funny because it doesn't seem like a high return, like 7%. However, when you look at this just on the long term, you know, 7% is going to really help you a lot. So you see that even the S&P 500 itself has averaged an annual return that seems kind of low. It seems like, you know, 7% is not a big return. But now you might be wondering, you know, if those people, you know, are averaging, let's say 20% a year, or the S&P is at 7% a year, and you just buying a call option, you made, let's say 30%, you started with $1,000 and now you earn $300 by, let's say, buying a call option, you were right, you made $300 and you technically made 30%. Where is the catch? Because you might think, why am I doing it so easy, or what seems so easy, compared to those people that, you know, manage to only make 20% a year, let's say over 30 years? Where's the catch? Well, there are different reasons that really explain why their performances is absolutely insane, and I'm going to lay down those reasons so hopefully it makes sense for you. The first reason why those returns are actually incredible, if you manage to achieve 20% a year on 30 years, it's actually incredible. And the very big reason why is that the account size really does matter. Meaning that when you trade or when you invest in the markets with, let's say, a $5,000 account, it's nowhere near the same thing as investing $5 billion. Because obviously when you manage other people's money and you just let's say manage $5 billion, you're not going to have the same responsibilities as managing, let's say, your own $5,000. With your own $5,000, you can afford to take risks to have more volatility in your P&L without necessarily being forced to close your position or do anything. You're just going to have a lot of volatility and hopefully it goes the right way. When you have a $5 billion account, let's say, you cannot afford to have, let's say, a 20% drawdown because you just, you know, bought an option and now it's going against you. You cannot afford to have the same volatility in your account because it's other people's money first, and second, because it's like a $5 billion account. And that's it's really, really something to understand is that if you have a small account, there's nothing wrong with having a small account, and I have a small account relative to those people, absolutely. But the thing is, it's not at all the same thing to manage more money compared to having a small account. You have a lot more pressure, you have not the same responsibilities, you're managing other people's money. I mean, it's not at all the same thing. Hence, it's a lot more manageable to achieve like this type of percentage on a smaller account when it's your own money compared to doing it with other people's money. Because think about it, would you trade the same way that you're trading right now with your own account? Would you trade the same way with a $5 billion account? Personally, I wouldn't because I know that there would be maybe too much volatility in the P&L and I just couldn't personally handle it. And obviously I'm more risky because it's my own money and I do whatever I want with my own money and I'm responsible for it. However, the risk that I'm taking right now, which I don't even consider big risk, would be still way too huge for, let's say, way bigger accounts that are managed, for example, by hedge funds. That would be way too risky for them. Side note, I'm talking about the average investor. I'm not talking about, for example, hedge funds who blew up with the GameStop movements. I'm talking about the average hedge fund or the average investor. I'm not talking about the ones that are going to take extreme risk, because of course there are, for example, hedge funds that are taking huge risk and they actually blew up, and we saw stories about this with the GameStop story. So here I'm really talking about the average investor and why it's not at all the same thing. And I don't know if you ever lost, let's say, for example, 5% or 10% of your account in one trade. Well, imagine what it would be if you were losing 5% or 10% on a $5 billion account. That would be 500 million if you were losing 10% of that account. You would be losing 500 million in one trade. So you see that you cannot do the same thing as when you're trading with a $5,000 account compared to a $5 billion account. In terms of risk, it's really not the same thing. And the second reason, and I think it's probably the most important one, because yes, you know, your account size can be different and this is something that is really more personal, but there is one thing that is going to really say if you are actually good at this or if you're not good at this, is it, can you do that on the long term? Because it's great to achieve great returns, it's amazing, you know, it's nice. However, how able are you to achieve that on, let's say, 30 years? Can you achieve that same 20% return on the next 30 years? Well, if you can, that's where it's really going to be amazing, and it's actually incredible if you can do this on the very long term. And that's why those people, as much as those 20% annual returns don't seem like a lot, very, very few people are actually able to maintain that on the very long term. And that's where the whole beauty of investing in the stock market is because it's a game of the long term. You don't want to just overachieve in 1 year and then lose everything in the next year. You ideally want to maintain that on the very long term. And usually, if you manage to, let's say, make 100% in 1 year, it's usually because you took some kind of risk. And if you make too much in a year, that usually means that you're taking on too much risk and you're not going to be able to maintain that on the long term. So as to be able to really maintain this type of average annual returns on the long term, you need to be really risk averse. You need to be really thinking very hard about your risk and the risk that you're taking, so it's actually doable on the very long term. That's why even though 20% might not seem like a lot, or it might seem that it's actually doable, and you know, it is doable, you know, the most important thing is repeating that year after year after year. That's where the real beauty of that game is, because it requires patience, because it requires discipline, because you need to be able to do it over and over. And if you don't necessarily have a methodology so as to achieve that on the long term, if you got lucky on 1 year, then you're not going to be able to do that over 30 years. And that's why these type of people, they're very much respected in that business, because they've been able to achieve that over and over. And I feel this is something that is so important to understand, especially when you're starting out. When I started out and I was, let's say, making 10% on my account, I was like, well, it's actually not that hard. However, I wasn't able to repeat that and do that over and over the years, because I was, first of all, not having a good methodology and I didn't know what I was doing. I didn't know how to manage my risk. I mean, you get the point. And that's really personally what I'm trying to do here. I'm trying to build a decent track record on, let's say, the next 20 years. So when I come back in 20 years, I have all of those track records over the last 20 years and I'm able to show my results and see what I've been able to do. However, I can absolutely say that achieving that year after year after year is extremely hard, because, for example, let's say that you had a great return in 2019. In 2020, there has been the crash. In 2021, or at least since the crash of 2020, the market has only been gone up. So you need to be able to adapt to those different situations. You need to be able to make money in different situations, which can be extremely hard, especially when the next bear market is going to happen. We need to be able to make money even during a bear market, which is usually going to test people a lot more compared to a bullish market, where in a bull market, as you might know, everyone makes money, or everyone, I don't know what's the sentence, I think it's everyone is a genius in a bull market. And that's really important to understand, that right now we have been in a bull market mostly since the 2008 crash, and when we're going to enter the bear market, that's really where a lot of people are going to start losing money. And if you keep maintaining a, let's say, a 20% annual return even during a bear market, that's really impressive. And the third reason why it's so important to understand that those returns, those 20% annual returns, are actually incredible. What does that mean? Well, I'm sure that you're familiar with the sentence, don't put all your eggs in the same basket. And what does that mean? Well, basically, if you put all your eggs in the same basket, you invest just in one company, your returns are dependent only on that company. For example, let's say that you invested everything in Tesla. If Tesla goes up, it's true, you're going to beat the, annual returns that those people do. It's true because, for example, Tesla has been going up like crazy in 2020. However, if you're wrong, then, your whole account could be just wiped out because of all this volatility. So diversification is going to smoothen the ride. And usually those people, they're not going to go all in into only one product. They're going to have a portfolio of different stocks. And by having a portfolio of different stocks, that's going to smoothen the ride, meaning that there's going to be less volatility. And the more diversified you are, the more your portfolio is going to have the same performances as the index. Because think about it. If you invest, like, let's say in the S&P 500, in the 500 companies that make the S&P 500, then you're going to end up with exactly the same performance as the index itself. It's logic. And that's the very big difference between, for example, these type of people and, I'd say us retail traders, is that as retail traders, we tend to have a lot more risk into very few companies. We tend to invest a lot more into single positions, hence having a lot more risk on individual positions. So being able to achieve an annual return of, let's say, 20% over 30 years and not being too invested in one company so as to smoothen the annual return is really, really impressive. If you can manage to actually be a bit diversified and still be able to achieve those 20% returns on, like, let's say 30 years, it's really impressive. And that's why it's so important to understand that, because obviously you could make a lot more if you were just like, buying at the money calls on Tesla and then boom, you make a lot of money. It's true, it's great, and you really made a lot of money, and that's amazing returns. However, once again, how doable is that on the long term? How doable is that on, let's say, 30 years? Can you make that on, let's say 30 years? If you can, that's amazing. But you need to think about it and how doable is actually that performance on the long term, because that's what matters in the end. And I want to show you this graph because I think it's really, really interesting. It helps put things in perspective. So horizontally, you're going to have the number of years where the track record has been maintained, meaning that, for example, if you see someone, let's say over there, it means that for 55 years, they managed to maintain an annual return of 5%. And that's really how this graph is. Vertically, it's about the performance, and horizontally, it's about the number of years that this investor has managed to maintain that return. So what we see, and let's say we take, for example, as an example, Warren Buffett, you see that he's over there. So for more between, let's say, 57 years, he managed to make a return of, let's say, around 12%, that's around 12%, 13%. And, once again, 12%, 13% on one single year, that's not a lot. However, on like 56 years, 57 years straight, that's amazing. That's really incredible. And you can see all of those different investors. And if you want, I'll put the link of that image of that graph in the description of the video so you can check it out for yourself. But what you can see is that none of them, he's, for example, averaging an annual return of, let's say, 70% on, let's say, 10 years, because the minimum number of years for that particular graph is 10 years. And what we see is that most of them are at maximum averaging 30% annual return. And what's funny and what's interesting to see in that graph is that the more you are into the business, the less actually you're going to earn on the very, very long term, meaning that Warren Buffett has been averaging 12-13% a year over 55 years. And most of the people that are in that category, where they have been there for, let's say, more than 50 years, they're not averaging like 30% a year. they are like at 12%, or like for example, Philip Carey is at almost 5% over 55 years. And the shorter term you go, and shorter term is quite relative, because for me, shorter term is like, let's say 1 or 2 years. For them, it's like 10 years. So obviously we're quite different here. But you see that the more shorter term you go, the more you can actually hope to make on the shorter term. Jim Rogers has been the highest, and you see that he has reached 30% a year over, let's say, 11 years. But you know, the longer term you go, the less actually annual return you're going to get, the more it's going to be smoothened. And that's quite interesting to see that all of those people are pretty much considered like the best investors of all time. But most of them, and actually all of them, have not been averaging an annual return of more than 30% a year. And that's quite interesting to put that in perspective when you think about your own trading. Like if you achieve 70% a year, that's amazing. However, how able are you to achieve that 70% over, let's say, 10, 20, 30, 40 years? And especially with everything that you see on internet, I felt that, you know, it's cool to see that actually this is more the reality of that game, and you shouldn't really be caught in everything that you see on internet. You should maybe try to benchmark again this type of people who have like real experience over decades and decades in the market. And I think it's quite interesting to see that if those people cannot make, let's say, 100% a year over like 40 years, well, then how are we going to be able to do that? And I think that's quite interesting, especially nowadays with everything that you see on internet and all the potential returns that you could make, or at least that are being advertised. It's quite interesting to see that actually the best investors of all time are only, and I really quote unquote here, are only averaging 20% a year over, let's say, 40 years, which is already really amazing. It's incredible. I really try to give a bit of context here, because obviously personally when I started out I was really biased, because I thought that, you know, making like for example 30% a month was like actually doable. But you know, when you look at the best investors of all time and you see their performances, it helps put a bit of context, and it resettles a bit the expectations that you should have about the stock market. If you enjoyed that video and you like maybe to see more videos like this one where I share my opinion on some subjects like what should you expect in terms of annual return, then don't hesitate to subscribe to my channel and liking this video. As I said, that's really the best way of letting me know that you appreciate this type of video and you like to see more videos like this one. Please make good and informed decisions. I'll see you in the next video, and in the meantime, I wish you all the best.